Think back to 1995. The movie Toy Story is in theaters, the internet is a brand new playground, and a single ounce of gold costs exactly $380. Imagine a simple A/B test. You take $380 in cash and hide it under a mattress. Then you take another $380 to buy one physical gold coin and store it in the same spot. 30 years later, in 2026, the cash is still $380, but inflation has cut its purchasing power in half. The gold coin tells a different story, sitting at an all-time high of over $2,400. That massive return usually leads to the same family conversation. Why didn't I buy more back then? We often assume a dollar will always behave like a dollar, but the math proves that holding pure cash guarantees a loss of wealth. In the first decade, between 1995 and 2005, gold was largely ignored. It crept up to about $440 an ounce, lagging far behind the explosive growth of the tech boom. The 2008 financial crisis changed the trajectory. As trust in banks evaporated, investors looked for security in hard assets, triggering a flight toward physical commodities. This chart shows the mathematical result of that panic. By 2015, gold's price had doubled, sitting near $1,200 an ounce. Driven by inflation and supply chain shocks, it continued to climb, breaking the $2,400 barrier in 2026. Gold functions as an inverse scale. It doesn't create value out of thin air. It rises to balance the scale as the value of the US dollar declines. Most Americans are conditioned to build wealth through real estate, tech stocks, or crypto. In this mindset, physical gold is often dismissed as a niche purchase for doomsday preppers. In countries like India, gold is an active part of the financial system. Families buy physical gold for weddings and pass it down as a form of generational wealth. The 30-year data suggests this cultural preference for commodities is a mathematically sound defense against the volatility of paper currency. This isn't a suggestion to dump your entire life savings into gold bars today. Gold is a defensive tool, not a get-rich-quick scheme. Its value lies in asset allocation. A hard asset acts as an anchor for your portfolio, providing stability when higher-risk investments become volatile. It is easy to look back with regret and wish you had bought Apple stock in 2001 or Bitcoin in 2015. Hindsight always makes the past look obvious. The erosion of cash value is a mathematical certainty. To protect your future self, you have to move your wealth into assets that inflation cannot easily melt away. Take a look at your own holdings. What assets are you keeping today to ensure you don't have that "I should have bought more" regret 10 years from now? Drop a comment below, hit the like button, and subscribe for more finance insights.